Hi guys, Roy Cousins here, training educational program. We're back, partnered with Liteforex broker. We're giving you the very best of the best, real high value tools, trading techniques, strategies, the stuff that I'm personally using to trade the markets for a living for the past 7 to 8 years. Now today I would like to focus on a very particular strategy that I've developed about 3 years ago. I finished up this strategy, and it was mostly to address the cryptocurrency market, which is why it got its name, 3D Crypto Sniper. Having said that, it is applicable to all markets whatsoever, right? It just happened to be useful for me in the crypto space. So I'm actually going to show you real live stuff, real positions that I took on the Bitcoin using this very strategy. That's going to be in the demonstration part. First, we're going to go through the definition of the strategy. We're going to work out the numbers and the basic conditions, and then of course we'll take it to the charts. So you ready? Let's go ahead and dive in. Alright guys, so in terms of strategy concept, it is pretty straightforward. We buy low, we sell high, right? The old cliche. In the case of this strategy, it's just because it is a classic trend following strategy, trend following system. So we try to snipe the tipping point, right? When it comes to a bullish setup, we would try to snipe the very edge of a downside correction to get in, and then we will automatically aim at the previous high, and obviously vice versa when we talk about a bearish setup. Now let's talk about the technical tools and indicators, right? The basic technical tools required to construct the strategy. So we're talking about daily chart. That's my basic chart. That's the chart that I mostly use. Obviously, it's applicable. You can apply this on a shorter term, time frame chart, such as the 1 hour or the 4 hour. But I happen to find it that the strategy is mostly useful on the daily chart. Now, we're using 4 indicators. Right, we're using 3 moving averages, which is what this is the 3D part, right? It's a 3-day moving average, right? We're using the 200 daily moving average, simple, right? The simple 200 daily moving average. We're using an exponential 20-day moving average and 5-day moving average, also exponential. So 2 exponential short and 1 long, which is simple. And we're using a 4th indicator, which is the stochastic oscillator by its default. We're not changing any numbers over there. We're changing some numbers, but not in the basic specification of the oscillator. And obviously, I will show you exactly what I mean by that. So it's pretty straightforward. I mean, it's pretty simple, right? We're talking about 3 moving averages and the stochastic oscillator. However, the combination of these indicators, the way that I actually apply that strategy, I think, is what makes the difference and what makes it much more sophisticated than it might look like right now. Now we have two basic conditions, right? We have the long side setup and we have the short side setup, right? The bullish setup versus the bearish setup. They're almost the same. When it comes to the moving averages, they stay exactly the same. The only difference is with regards to the stochastic oscillator. When we're talking about a long side setup, the levels are 35 and 75. When we're talking about a short side setup, we're talking about 25 and 65. These are the levels inside the oscillator, right? The stochastic oscillator. Now, in terms of the conditions of the moving average, or should I say the moving averages, here what we require is, in a short side setup, for example, we require that the 5-day moving average, which is the fast line, let's just call it the fast line, right? The fast moving average would be below both 20 and the 200, where the 20 is also required to be below the 200 itself. You follow what I'm saying, right? And of course, when it comes to the stochastic oscillator in a short side setup, the fast line has to be below the slow line. There are two lines in the stochastic oscillator. After they have engaged, well, the fast line had engaged with the 65 level. Let's take a look at the long side setup. Here we're using slightly different levels when it comes to the oscillator, 35 and 75. Here we require that the fast line would be above the slow line after engagement with the 35 level. Now, this is just, the basic definition of the strategy. At this point, we need to take it to the chart and see exactly how this thing works out. But just before we're going to take it to the chart, I want to talk about the risk and money management, right? We have kind of a built-in tactic in this strategy when it comes to money management. Entry, the full setup gives you the green light, right? When the stochastic is in the right position and all the moving averages, right, are in line according to our basic conditions, we get that green light from the strategy. Now, like I said, we exit at the previous local high if it's a bullish setup, or low if it's a bearish setup. That's going to be the price target for a particular position. And we're also using an initial stop loss level, right? An initial stop loss order, which is the same distance from the entry price to the price target. So whenever we get the entry price, or whenever we enter the position, we measure the length, right, from the entry to the previous high, for example, in a bullish position, right, in a bullish setup, and we apply the same distance as a stop loss level, right? Makes sense? Ratio would have to be 1 to 1. We also have a second step stop loss. Second step stop loss, that's where the stochastic hits the opposite level, right? Let's say we came from below, the stochastic hits the 35, we entered the trade, and if the stochastic makes it to the other side, meaning the 75, we're talking about the fast line, it's always the fast line. What we do is we move the stop loss level to that very same bar, right, where the stochastic made it to the other side. And we take a look, we take a look at the lowest low on that bar, and we place our stop loss level right below, just a tag below the lowest low. We also have kind of a manual exit, if you will, right, where if price doesn't make it to the previous high or previous low, there's also a manual exit. We actually have two of those, where the stochastic fast line cross back, right? Cross back the slow line, plus the 5-day moving average is being crossed by the bar itself. The bar itself closes beyond the fast moving average, basically the 5-day. That's enough for me to pull out, right? I'm not gonna wait neither for the stop loss level or the take profit or the price target. Same with the second manual exit, which here we're talking about a bar which goes beyond the 20-day moving average. Straight up close beyond the 20-day moving average. That's enough for me to get out. It doesn't matter if it's if I have a big loss, small loss, profit, I just get out. These are the basic conditions that I'm trying to follow throughout the whole trading activity whenever I'm using this particular strategy. Alright, so I'm taking you straight to the chart, and I want to show you a specific segment in time between April 2017 and September 2017, I was very active on the Bitcoin, and one of my strategies was this one. I was using the strategy throughout 2017. I was using the long side setup. When 2018 began and it was obvious that we've entered a bear market, then I started using this very strategy from the short side setup. Right now, I've already placed the moving averages and the stochastic. Remember, I told you we were talking about the fast line and the slow line, and the stochastic. You can see there are two lines here. Right, we got that red dotted line. That's the slow line, and we got that greenish bluish line, which is the fast line. Right, and most of the time we refer to the fast line more than the slow line. Now, another important thing, an important tool that we will need to use here is the data window. Let's take a look at that. Right, the data window, that will give you just an accurate analysis. Whenever we're going to use numbers, right, we're using numbers here pretty often, then we're going to use the data window to give us the exact numbers, the exact values, which by we make decisions. Now, like I said, you remember at the beginning, we're talking about a classic trend following strategy, which means we're not only tracking the trend itself, but we're waiting for price to pull back for what we call, a technical correction. And then we try to snipe, to catch the very tipping point, the very edge of that downside correction, just as it turns back up, right, and resume the original trend. So whenever that happens, that's pretty easy to see. It's very visible. It's a very visible move, right? We have an upside move, and at some point, price begin to drop in a downside correction. Whenever that happens, it's always in accordance with the stochastic oscillator. So it's easy to see. You have the same reaction coming on the stochastic oscillator. So when price dipped right around May 2017 and began to turn around at some point at the beginning of June, I was the first thing I do when it comes to this particular strategy, the 3D crypto sniper, is to look at the stochastic. Now I'm going to bring my cross tool here. And keep your eyes on the data window, right? You can see in the data window, we have the values for each bar. We can find the values of the fast moving average, right? The medium 20 moving average and the slow 200, as well as the stochastic, both of its lines, the fast line and the slow line. Now here's where the downside correction was peaking, right, on the downside. Take a look at the levels of the stochastic, right? And I'm talking about the fast line, right? The fast line basically at that point is at 31.6, so it just crossed the 35. That's the very basic condition. Once we have that, all we need to make sure is that the fast line, the fast moving average, right, the 5-day moving average is above the 20. And as you can see, it is, right? Fast is 21.21, the 20 is 19.13, so definitely above, and the 20 as well is also above the 200, right? The 200 is at 10.82. So this is exactly what we call an ideal condition, where we get that green light, right? We get that green light at that point. But you also remember what we want to have at the moment of strike. The moment we pull the trigger would be when the stochastic, the fast line, is crossing above the slow line. So let's take a look at that very moment where we had price was peaking on the downside here. The fast line, right? I'm talking about the stochastic, was the 31, well below the slow. By the way, the slow line is described here by the word signal, right? That's the slow line at 54. Now I'm moving on to the next bar. Take a look. Here, well, the fast line is still well below the slow, right? 23 versus 36. But that changes with the next bar, right? The next bar, the fast is moving above, is crossing over. And right now at 32, and where the slow is at 29, right? That is the very moment, right? That's the very bar. Right on the close of the bar. It has to be always based on the close of the bar. In this case, close of the day, because it's a daily chart. So when the market closed that day, right, when we arrived to 12 a.m. GMT time, and the bar was set with the close, that's where you measure the values against themselves, right? And we see here that we got the green light. So as the next bar opens up, that's where I've pulled the trigger, roughly around the levels of 22.25, right? Talking about 2,235, almost 2 years ago that was, when the market was still strongly on the upside. So this is where we pull the trigger and we enter the trade, right? We enter the trade. The first thing we want to do is take just a simple horizontal line and place it exactly on top of the previous high. We're talking about the previous visible high, right? Anything that you can identify clearly as the previous high. So you can see here it's not a big move to 27.35 from 22, from roughly 22.30. We're talking about 500 points. And when you were measuring the entry to the price target identifying here 500 points, that's exactly the number, that's exactly the distance we add on the downside to reach a stop loss level, right? So 22 something minus 500, we're talking about roughly the level of 17, right? 1,700. So that's pretty much the very basic action that I'm taking when I have that green light. Now, let's follow up with what happened here later on. Price began to, well, it just continued on the upside, right? Ever since I got in, price continued to move up. But at some point, take a look on this bar, which was just 2 bars after I got in. Right at the close, take a look where the fast line of the stochastic is, right? 77. So it just crossed above the 75, which means that at this bar, well, actually at the next one, I took the stop loss level and pushed it all the way just a tad below the lowest low. Now, there is a bit of a variation at this point. We could take 50% of the profit out, right? Like, use this particular moment as a profit-taking spot, just for partial execution, partial profit taking. So we can take out like 30%, 40%, 50%, whatever, and just continue with the rest. But of course, moving the stop loss level to that lowest low on that particular, the next bar actually. Or we could just leave it the same. These are 2 slightly different variations of pretty much the same money management tactic, right? Nothing has changed beyond that. But I'm usually not using this as for partial execution. I just push the stop loss level adjusted accordingly to the conditions, and just carry on the position as is. Now in this case, a few days later, price took the price target at 27.35 and I was out. Right? Pretty straightforward. Later on, I had another signal. And it was, let's see, we had it right here. I mean, at this point, right, where the stochastic was below 35, no doubt, right, actually well below 35. This is the bar, take a look, that, let's see, the fast is below actually. Alright, it was here. It was right here. Take a look. So the fast line is at 31. Stochastic is at 31. The slow is at 33. Right? The next bar, the crossover. Fast line 41, slow 35. You see this? Now, at this point, right, we take a look at the moving averages. We see that the fast is above the medium, which is above the slow. Right? So this is where we get the green light. This is the bar where we enter the trade. As we enter the, as I did at that point, I entered the trade. I entered a bullish position, and the following day was actually going against me slightly, but at some point it went pretty nicely to the upside. However, it wasn't sustainable enough. It did not reach the previous high, right? So I'm showing you a position that didn't went too well actually. Didn't go too well. It did not reach the previous high as expected from a typical, upside trend. In fact, it was having a larger scale downside correction later on, but obviously we couldn't know that in advance. So price began to trade slightly sideways, right? A few bars. But here's what was interesting from the money management point of view, because take a look at that same bar that kind of burst, right, strongly to the upside. It sent the stochastic to 65, the fast line, right? The next bar, the stochastic was already at 81, right? So it was above 75. So what I had to do at that point was to take the stop loss level and push it all the way to that same bar, right? We're talking about this one on the 21st of June. So I was actually able to get out at pretty much on the break-even point as that stop loss level was triggered a couple of days later. Which is why that money management can actually help us minimize losses, sometimes completely prevent them, if things don't go our way, right? Because what we always try to find is that typical upside structure where we have higher lows and higher highs, right, consecutively. Later on, I had another signal coming from the system. By the way, all through throughout all of that time span, there were seemingly a few signals, but they were not complete, right? All the conditions were not met. We're looking for all the conditions to be met, right? Now here's what happened at the 22nd of August 2017. There was a visible drop in price, right? There was a visible technical downside correction and a nice turnaround. Let's take a look at the stochastic, because that's where we're starting from always, you can see. So we just need to make sure that when we had that downside correction, the stochastic did reach the lower section, meaning the 35 level, right? And obviously it did, right? It's at 32, and right here it's at 32, where the fast is still below the slow, 32 to 39. But take a look at the next bar, right? That's the crossover. So we have this, we have the fast now at 39, where the slow is at 35. And what about the moving averages? So the 5 is at 4,000, the 20, 3,7, and the 200 is at 1930. So all the conditions are pretty much in line, right? We got the green light here. And I just entered the trade. I just entered a bullish trade right on the next bar, right on the beginning of the next bar, right? And then of course I take, a price target. I place a take profit order right on that previous high. Right? Let's give it the green color. And I measure the distance, and I apply that distance pretty much for the same for the stop loss level. Now what happened here next was, as you can see, price was beginning to change direction. This is a classic sniping system, right? That's the whole purpose of the strategy, is to find these tipping points, right? These lows when it comes to bullish trend and highs when it comes to bearish trend. And price went very nicely at this bar. It actually, the fast line of the stochastic hits the 78, right, at the close. So we take the stop loss level, we push it all the way right here. Now, here price didn't make it to the previous high. It was actually triggered, the stop loss level was triggered, right, as you can see, with a small profit actually. So sometimes that's also a possible scenario where you push the stop loss level from risk management standpoint, but before price will make it to the previous high, it might also take your stop loss level. So that's also something that could damage a profitable trade, but it could also, as we saw in the previous example, it could prevent an obvious loss. So guys, I think you got the picture, right? Like I said before, it's pretty straightforward. The unique combination of the implementation of these indicators and these moving averages, that's what makes this strategy, I think, special. I hope you enjoyed this particular session, training educational session, the 3D Crypto Sniper. I hope it will be helpful for you and you'll be able to use it to your benefit. At this point, I will say goodbye, and until next time, be well.